Good afternoon, and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. Before I introduce today's presenter, a few quick reminders as always. Everyone that is registered for today's program will receive a copy by the end of next week. And if you have any questions, feel free to enter them into the lower right side of your interface under the Q&A bar. Today, we welcome back our good friend, Cox Automotive Senior Economist Charlie Chesbrough, as we close out an unprecedented year. Charlie, I imagine you have a lot to cover today, so I'll let you take it away.
All right. Well, thank you very much. And we do have a lot to cover today. I probably have too much to try and squeeze in, but I wanted to get you guys all the numbers and what we're seeing out there before we finish out the year. As I was saying to Rachel earlier, I hope I'm not going to be considered the Grinch who stole Christmas, but we are starting to see things out there look a little bit tougher for the vehicle market. And I'm sure you all are well aware out there that the economic conditions are changing rapidly, and we're seeing that vehicle sales are looking under quite a bit of pressure this month. So we're heading into the first quarter with quite a few headwinds. We're going to take you through what we're seeing and then give you what our outlook for next year, which I think looks much better than what we're doing this year. So we're going to start by looking at the virus itself and what's going on with the U.S. economy. Then I was going to take you through some few slides that we have looking at some survey research, looking at what is the view from market participants, what are they thinking, what are they seeing from both the folks that are buying vehicles and you dealers yourselves, and what your view is of the current market conditions. And then I'll take you through some of the new and used market numbers and what we're seeing out there, and as I said, what we're expecting going forward. So let's start by talking about the virus itself. Really not a lot of good news to report about that. We've been tracking this on a daily basis here at Cox Automotive since all of this hit the fan back in mid-March. And as you can see here on the left, the 7-day moving average of daily cases is at record highs. We did 250,000 new cases yesterday. We also reached the highest number of deaths since this pandemic began at over 3,600 folks that lost their lives yesterday due to COVID. So we're ending this year with the virus really quite rampant. And as you can see on the right, we've been tracking where is the virus bad and not so bad around the country by county. And we've been doing this for a number of months. And if you remember way back when, we had many, many more blue and yellow markets out there. But unfortunately, you can see red is just about everywhere in the country. So this is something we're going to be dealing with certainly throughout the first half of next year. We got to get those vaccines around. The expectation is from a lot of folks that once those vaccines get out there, once folks start to feel more comfortable and not being so worried about this virus, the economy is in a very, very good position to have a fantastic second half of next year. So that's what a lot of folks are really kind of hanging their hat on. But we got to get through the next few months in particular because it's going to be tough. Talking about the economy, gross domestic product, this is just showing quarterly GDP growth going back for the last 20 years. And you can see what we've been going through here with this virus. It's really just quite phenomenal. We had a first quarter where GDP growth was down 5%. Then it fell 31% in Q2. And then it bounced back up 33% in Q4. I left on there the decline that we had during the Great Recession, which at that time was one of the most significant recessions we have had. And yet, look at it, it looks almost quaint in comparison to what we're dealing with right now. We still have huge unemployment. That's the big problem right now. Still, I think it's in the neighborhood of, 10 million folks that are still collecting unemployment from the original layoffs back when COVID happened back in March and early April. We had continuing claims numbers come out today that were close to 900,000, which means, new weekly claims of folks that have just applied for unemployment insurance in the last week, 900,000 more people. So we're starting to shed jobs. The economy is starting to weaken. And that's why there's all this talk about wanting to get the stimulus bill passed by Congress by today, because I think that this is the deadline that it's got to happen for it to be implemented, because the economy is starting to worsen and there's a lot of people hurting out there. So that's one of the worries we have, that we could slip back into recession. And so that's what we're keeping an eye on here as we finish the year and going into the first quarter. But it's not all terrible everywhere out there in the U.S. economy. And I pulled out some data that we get from Equifax, which looks at people's credit card purchases, and we can look at a year-over-year basis. How did that spending change? On the left here, I pulled out some numbers that look at auto-related transactions, and really kind of the more interesting ones here are auto rental. You can see in yellow, that's still down substantially, down 20% from where we were at the same point last year. And ride hailing, it's down around 35%. You know, it's I think that's one of the interesting things from the pandemic is all this talk of Uber and Lyft taking over urban America, and nobody in cities want to own cars anymore. Well, we can certainly see that when a pandemic comes, people their appetite for that ride sharing application falls dramatically. So it may be a little bit premature to declare their takeover. And we can see on the right here, consumer spending for different sectors of the economy. It's kind of interesting. You can see sporting goods, toy stores, and interior furnishings are actually up on a year-over-year basis from where we are at right now. But it's really anything travel related that's down substantially. Airlines still down 70% in terms of spending year over year. Hotel, recreation, you know, that's likely to stay in that situation until we get this vaccine distributed and we start to get on the other side of this virus. So that's kind of a quick update. As I said, there's not a lot of good news when you're talking about the economy right now, but we do expect things are going to start to improve here once we get past this first quarter and, as I said, into the second half of next year. Now, one of the things that's holding everything down is consumer sentiment. And we do monitor consumer sentiment out there. We need to have folks that are optimistic on their economic situation, optimistic on the economy, because those are the folks that are going to be willing to borrow $35,000 or $20,000 to go out and buy a new or a used car. And so you got to have higher confidence if you're going to take out that loan. What we can see here is looking at this year, how consumer sentiment has tracked. It fell dramatically at the worst of this virus back in mid-March and has essentially stayed there. We've had a very gradual recovery from 81 towards 87. But that's not any kind of a V-shaped recovery on that. And as you can see, in recent days, really since the election, we've seen the confidence has kind of ticked down. And we think that that's really a direct response to the virus really starting to explode here in the last few weeks, really kind of taking away folks' optimism out there. But we also know that the election itself has had implications. And I won't spend too much time on this because if you sat in on these calls before, you've seen this slide before as well. But I just want to give myself a little pat on the back because I did tell all of you that we were going to see some substantial changes in consumer sentiment because of the composition of consumer sentiment. And what this chart is showing in green was that consumer sentiment I showed you on the previous page. But we know that consumer sentiment is made up of a mix of people, rich people, poor people, urban people, rural people, and Republicans and Democrats. And we know historically that when the presidency changes hands from one party to the next, there's a massive shift in consumer confidence as people decide the glass is now half full or the glass is now half empty, depending on not whether my guy has won the election. And what was most interesting is when President Trump won the election, we saw a huge explosion in Republican optimism, while the Democrat optimism fell dramatically. And what I've highlighted with the dotted circle there is the purple line, which was the gap, the optimism level of how much more Republicans were optimistic over Democrats. But since Biden has been elected, you can see that purple line is just falling through the floor. And just to give you an idea, a year ago at this time, the gap was 46, such that Republicans their optimism was 46 points higher than Democrats. Today, it is 6 points lower. So there has been a massive flip in who is optimistic out there and who isn't. And that may have an impact on who's going to be coming in and looking at vehicles here in coming weeks. And just to kind of, as I've said, it's, you know, who's going to want to go out and buy. We may see red state interest in trucks may start to wane a bit. We may see blue state type people's interest in electrics alternatives. That may start to rise. So we may see some impact on different brands. And just to illustrate, I'm not trying to pick on LEXUS, but we do have access to some data where we can actually look at net purchase consideration. Folks who are in the market actually considering buying a vehicle, what is their party affiliation? And what we can see is that essentially Republicans and Democrats had basically the same purchase consideration of LEXUS until the election happened. And then all of a sudden, you can see that folks that support President Trump, their interest in Lexus has fallen dramatically. I don't think that has anything to do with anything Lexus is doing. It's simply that changing line of who's in the market, who's going to be wanting to buy as a result of this election. It's going to be moving a lot of parts. So I just suggest to you that's one of the things to keep an eye on, because who's coming in shopping is likely to change. The other thing we do at Cox is we do a number of our own surveys where we try to monitor what folks are thinking out there in the marketplace. And one of the things we do is we try to establish what percentage of our consumers out there are in the market to purchase a vehicle sometime in the next 6 months. And what you can see here is that it's been a fairly stable number through the course of this year, around 20%. 1 in 5 folks that we talk to are considering buying a vehicle, new or used, sometime in the next 6 months. But you can see that it actually was up just post the election, and it's now to 20%, and now it's starting to fall back down again. So we are starting to see that there is some changes here in recent weeks. It's hard to know how much of it is attributable to the election and how much of it is attributable to the rise in COVID cases, because certainly they're going hand in hand in terms of moving the needle out there. But we also ask folks, if you're in the market, are you going to be delaying your purchase or your lease? You can see this number has been fairly stable through time. It's essentially 1 in 4 folks is going to be delaying. It hasn't really had much movement on this. But I think one of the things that's kind of interesting are the reasons why folks may want to delay. And certainly the number one reason is folks are concerned about the costs and their own financial situation. But what I think is particularly interesting is the very last one on this list, waiting to see if a federal government will provide a second stimulus check. Only 13% of people are waiting for that. The last month that we did this survey in November, that was number 2 on this list. So folks, it appears, had kind of given up on the government getting them that second check. So there may be a little bit of a boost if the government can actually get this thing passed today for folks maybe weren't expecting it. So maybe a little bit of a Christmas surprise for folks. The other thing we look out there is what are dealers thinking? And we do the dealer sentiment survey each quarter to try and monitor what is the dealer outlook on the marketplace. And we have a number of questions that we ask. And this one is, how would you describe the current market for vehicles in the areas where you operate? And you can see the most recent data point is ticking down from where we were just in the third quarter. So, in the third quarter, we had a very, very successful period. These numbers were at their record in terms of our own index. It doesn't have a very long history, but people had a very nice third quarter. Sales were very, very strong, and of course, profits were particularly strong. But it's starting to pull back a little bit as folks, the dealers are getting a little bit more concerned. We can see franchise dealers are quite a bit more optimistic than independent dealers, but in general, everybody is headed in the same direction, and that is ticking down. What do dealers think is going to be like in the marketplace 3 months from now? Well, they're thinking things are going to tick down. So everybody is, I think, prepared with some realistic expectations that as we start the next year, we are going to be in a little bit tougher situation. The stimulus checks that came out after the initial hit of this virus last March and April, that was a long time ago. That money is gone. Folks are waiting for this second round. So it's not surprising that we're seeing some fatigue out there in interest from consumers because they're really probably just kind of strapped right now in general. The other interesting thing out there, though, is how would you describe profits over the last 3 months? Well, the Dealer Sentiment Index is suggesting that things are still quite good out there. So I'm glad everybody is making money. I think that's fantastic. And I think that one of the things that we are likely to see going forward is that prices are likely to stay relatively strong. It's hard to see because we are still in a relatively tight supply situation, at least over the near term, that we're going to see a substantial change in price or a substantial collapse in demand. So that combination would suggest that price should remain fairly strong, and that should help support relatively strong profits, at least over the near term. But one of the things that we'd also ask about is what are some factors holding back your business? There's a whole list here, but clearly the number one is the virus itself, with 47% of dealers saying that is the number one factor right now. But the other ones I think kind of interesting are numbers 2 and 3. And number 2 is limited inventory. Dealers were saying that was a major issue. And in fact, just last quarter, that was at 60% of dealers were saying that was a major issue. That's fallen back to 45%, so a significant decline. And they're also saying that what's another obstacle there is the political climate, and that's actually risen substantially. So just as I showed you on that previous slide of the moving sentiment out there among Republicans and Democrats, all of that is going to have an impact on your business here in the first quarter. So it's just best to be aware of that. So let's get into the numbers themselves and give you an update of what's going out there for vehicle sales. It's really we're in negative territory for both the new and the used market. And on the left here, I'm showing the rolling 30-day sales. You can see we had nice V-shaped recoveries in both markets, but the markets actually had a very different response to the virus. You can see on the right, that's probably a little bit more illustrative. That's showing the annual change in the number. And you can see that both the new and the used market fell a little bit over 50%. It's sort of the worst of this crisis. But then we saw the used market really bounce back incredibly strong. It was back to positive year-over-year territory in the early days of summer. And I'm sure you all were well aware of all of the interest in used vehicles. New vehicles came back, but it was a much slower pace of recovery. Part of that was certainly the high sticker prices of these vehicles. And certainly concerns about whether people wanted to spend that kind of money. And of course, the factories themselves being shut down really held back sales from really being able to fly off the shelves. But what we know now is that both these lines are in negative territory, and they're in very similar situations, down somewhere in the neighborhood of 10% to 20%. And this is retail sales. But it is stabilizing a little bit. And that's one of the good things, that sales have fallen, but they're not continuing to fall. And one of the metrics that we watch quite closely is what we're seeing in terms of credit applications. So this is credit applications of folks that have applied to have credit. Doesn't mean that they actually ended up buying the vehicle, but they applied. They were interested in actually purchasing that vehicle. And you can see that it looks very similar to the sales market, but we were looking at a very continuous decline in the percentage year over year on credit applications until we got to just a couple weeks ago. Really, we're just right after Thanksgiving, and now it's starting to show a little bit of improvement. And I think it was certainly the concerns around the election and the virus itself. All of that probably held folks back a little bit. Well, the question is how are we going to finish out this month? You know, the credit applications suggest it's going to be weak, but maybe it's not going to be continuing to weaken. Now, one of the things we have to keep in mind is that there's massive geographic differences around the country. And I pulled together, and I've showed some slides on this before earlier this summer as to how different states were responding. I just kind of wanted to revisit it to see where we're at. And I pulled out the data for the 9 major regional areas around the country. And I think it really kind of illustrates the variation as to how this virus impacted the market here in the United States. And you can see that green line, that's the mid-Atlantic. That's New York, Pennsylvania, New Jersey. That's the area of the country that was really hit the hardest in the early days of this virus. Year over year, sales were down 75% for that area. And then it had a very strong comeback. That green line actually was up year over year come June. But now you can see that it's trending down. Interestingly, the market that's done the best so far is that red line, which is Kentucky, Tennessee, Alabama, Mississippi. These are markets that really didn't shut down. They kept sales operations going. The governors didn't close down operations like they did in Pennsylvania and New York. And so sales never fell quite as much. They only fell a maximum of around 20, 25%. And they actually, in more recent data, are actually showing some year-over-year gains. However, you can see their trajectory is down. And in fact, all across the country, in all of these 9 different regions, the trends over the last recent weeks, you can see all looks very similar. So we're all kind of in the same boat. Just to kind of make this point again, I just pulled out the largest states just so you can see California, Florida, Texas, New York. Clearly, the worst of this virus hit the major markets quite differently. However, as you can see on the other end, we're all pretty much almost exactly these 4 major states as we're leaving November are all looking to be down, somewhere in the neighborhood of 10 to 12% there. And then just to show you all 50 states, you can see across the board on a year-over-year basis, everybody is down except for one state, and that's Montana. They're the lone holdout there to be up just a little bit. Unfortunately, it's a very, very small volume market, so it doesn't really have much impact on the marketplace. But you can see nationally we're down about 17% year to date, but there's really quite a variation around the country. I think if we had to say that there's one assumption we can make from that is that early hit states, your California, New York, Washington, states where Democratic governors had to shut down operations because virus was breaking out and there was a lot of concern. Those volumes are down substantially more in general than you have on the far right, which are many of your larger open plain states, areas of the country that did not get hit hard early on, and governors did not shut down business operations. So as we judge winners and losers this year, I think we have to keep all of that in mind because there were so many things that were in play that were really out of the control of any of the manufacturers and really out of control of consumers. So we just have to keep that in mind. So the official numbers for the new vehicle market, I have the light vehicle sales SAAR here on the left. We finished the month of November with a 15.6 million selling rate. The concern about that is that is the second downtick that we had from the light vehicle sales SAAR. We hit a 16.3 million rate back in September, so we were down just a little bit from the 17 million that we had done last year. But the last 2 months, it's continuing to downtick. So the concern is that we've kind of lost some of that momentum, and the market is starting to wane here as we finish out the year. And so if we look at year-over-year sales, our expectation at this point is that we're going to finish around 14.3 million vehicle sales, light vehicle sales for this year. That's down about 16% from what we did last year, that 17 million. But we're expecting the market to improve next year. We're expecting volume to improve to 15.2 million, or about a 6% gain. Now, that's a pretty conservative estimate. I would say we track what sort of the market folks are saying out there, various banks and Wall Street firms, and there really is no consensus. It's quite a variation in terms of what are the expectations for next year. I've seen as high as 16.8 million. I can tell you some of the major Detroit manufacturers are more in the mid 16 million range. And I can tell you that there's a number of lending institutions that are in the mid 14 million range. We're coming in at 15.2. We're going to stay on the conservative side, really, until we get a stimulus bill planned, until we get a transition of government, until we kind of get through the early stages of the worst of this virus here in Q1, as well as the potential of a second downtick in the economy. We're going to stay on the conservative side. But I would tell you now, my own personal expectation is that we should do better than that this year. I guess what our advice is to hope for the best, but plan for the worst. The other thing I think it's important to note is that the types of vehicles that folks are buying has really changed quite dramatically this year. Car sales are down 29%, while truck sales are only down 12%. So it looks like it's been a tough year for car, but I would suggest to you that maybe we're starting to see a little bit of a rainbow at the end of the car path. This is showing passenger car share over the last 10 years. 10 years ago, it was a 50-50 market. It was 50% car, 50% light truck. It's been progressively declining through the last decade until we reached the bottom of around 22-23% market share for cars. But you can see the recent data points is since May, car share of the market has actually been ticking up. It could be that we are finally at the bottom of declining car share, and that would make sense because we know that Ford Focus and Fusion and Cruise, these high volume small car vehicles have gotten out of the market. That's certainly been contributing to smaller car share, and we would expect for a long time that these are lower priced products, that there should be more interest from consumers in them. So maybe we are starting to see that on a relative basis, cars are starting to hold their own a little bit. It's certainly something to keep an eye on here as we go into 2021. So just looking at year-to-date brand sales across the board, pretty much everybody's in the same boat. Everybody's down, but just like Montana was up, Tesla's the lone holdout there. They're up a little bit year over year. Probably their direct-to-consumer business model, as opposed to selling through dealerships, maybe insulated them a little bit from some of the shutdowns around the country and maybe some of the concerns around the virus of folks going out in public and shopping at dealerships. But we can see across the board that everybody else was down. But on the far left, you can see that some brands were down substantially. And Fiat They had a tough year. They don't have a lot of new product. I don't know how much longer they're going to be around, but they certainly took a big hit. But Dodge and Nissan as well. Certainly, in Nissan's case, they're heavy into fleet activity. That pullback in the industry certainly had an impact on them. And they've got quite a bit of old product, but that is going to change for them in the coming months. So they've got a number of new products coming in. I think the new Rogue is going to be coming. That certainly will contribute. So my expectation is that Nissan should be doing better next year, and in part is a low basis to work from. So they should see some substantial gains. But it's really quite a varied market out there, and as I said, certainly geography has a lot to do with it, but also I think that the make of the customer base, and I'll talk a little bit about that as well. And if we talk about winners and losers out there, this is looking at the change in market share year to date, so not just change in sales, but we can see that if we had to declare winners so far, if we're going by market share, probably profits are a better measure. But if we're measuring by sales, you can see that Kia and Chevrolet have really had a very, very strong year, and at the expense of Nissan and Dodge and Infiniti for the luxury brands has certainly had a rough year. So a lot of moving parts. As I said, I'm reluctant to sometimes show this because many times I'm talking to OEMs and they see their company up there, and they're concerned because they don't want bad news to be going out there about the company. And as I said, a lot of moving parts this year that was really just out of their control. When we look at some of the different segments on a year-over-year basis, very similar. The nation was down 17%, but clearly on the far left, we can see a number of car segments are down substantially more. Luxury car, full-size car, compact car, those have been down substantially. And then on the other end, you can see that crossovers have actually done relatively well. The small crossovers, as well as pickup trucks. They're down, but on a relative basis, they actually have held up quite well. And we know that those pickup trucks are having very, very high sticker prices. I know as international auto dealers, pickup trucks aren't a big portion of your business, but it's certainly something that seems to be holding up well out there. And maybe it's time to start urging all these German and Asian brands to get much more aggressive into having a larger portfolio of pickups, because it seems to be that's what the American consumer wants out there. And just looking at winners and losers in terms of changes in market share, full-size pickup trucks been the big winner this year. You can see it's up, gaining over 1.5% market share. I think a lot of that was gobbled up back in the early days of the pandemic when the Detroit 3 went aggressive on pickup trucks and offering 0 for 72 and 0 for 84 financing offers. We know they were flying off the shelves in the Southeast and the Southwest. And pickup trucks are probably going to stay a pretty hot item going into 2021. The new Ford F-150 is going to be coming out, so there's going to be a lot of interest in that. And at the other end of the spectrum, you can see compact car, minivan, midsize cars. They've taken a big hit. As I said before, car share looks to be starting to stabilize and maybe turning a corner. So I would expect compact cars should have a better year next year, now that we've sort of moved out of the way a lot of the old product that folks, a lot of the OEMs that were getting out of that segment that had cleared out their available inventory. The other big thing that's been going on in the market this year has been through interest rate financing. I've showed you guys a few of these slides before, but I just want to walk you through them again just to finish out the year. Probably the only cure for COVID we know so far is 0% financing. As I said, the industry went heavy into this back in April and May and really had a huge impact on vehicle sales and jump-started the recovery here in the market. But they've been backing away from that since then. We haven't seen quite near as aggressive incentive offers, in part because they haven't been necessary. That demand has come back relatively well. Inventory levels have remained relatively in check, that the industry hasn't had to pull that trigger like they did before. However, that may change. That may be something that they decide that they do have to get aggressive about again. So that might be something they may make that move here. If they haven't already, I haven't looked recently to see what some of the new Christmas deals are, but I'm guessing that we're seeing a lot of 0% offers out there because that is something that consumers are interested in. But one of the big changes that we have in the marketplace post-COVID is there's been a substantial shift in who is buying vehicles. Unfortunately, I don't know, I can't get data on, I don't have access, I'm sure it's out there, but on what is the FICO score of people that are buying vehicles in the marketplace. And, but I do have what is the interest rate that they contracted for. And what we can do is we can make some assumptions that a person who is able to acquire a low interest rate is probably a high FICO score customer, and someone who contracted a high interest rate is probably a low FICO score customer. So when we look at the marketplace, I have here on the left, this is market share each month, January through November, of what share of the market were people paying a 4% interest rate or less, what share of the market did people contract for an interest rate with a 4 to a 10% interest rate, and what share of the market are people paying more than a 10% interest rate. And you can see that come April, we saw a huge shift upward in terms of the share of the market that is paying less than a 4% interest rate. That corresponds right in with that 0% financing offers we saw on the previous slide. But what's interesting is we've stayed at this level. The composition of folks that are paying this less than a 4% interest rate has made a 15% market share gain, and it stayed there. And where have we seen market share losses? Well, it's come directly from folks that are paying higher interest rate. And to me, that suggests that we've seen a change in the composition of the marketplace, that the people who are coming to buy a new vehicle today have higher incomes, have probably been a little bit insulated from the downturn. We've lost the hourly worker, or the folks that are sort of at the lower end of what they can afford in the new vehicle market. And that's why we've seen this shift. And if we look on the right, this is just what is the average interest rate out there in the market. And you can see it's fallen dramatically, but it's hanging around pretty stable right there around 4.5%. Now, that means that different brands out there have different customer bases. And this is, I've shown you guys this before, but I think it does illustrate what is the vulnerability out there. And this is just showing what is the average interest rate of folks in 2020 that purchased a retail, took a loan out on all these different brands. What was the interest rate that they contracted for? And you can see Mitsubishi, Dodge, Nissan, their customers are paying some of the highest interest rates in the industry. And I think it's no mistake that we also saw those same names as having the worst year-over-year sales. Their customers have probably been hit pretty hard by the job losses in this pandemic. And we can see on the other end of the spectrum, Land Rover, Volvo, Subaru, their customers have some of the best interest rates in the market. They're probably fairly insulated from the economic turmoil that we've all been dealing with. And just to kind of hit the point home, this is looking at what share of each of these different brands, what share of their customers are paying less than a 4% interest rate, and what share of their customers are paying greater than a 10% interest rate. And I would argue it's that red bar where brands are most vulnerable. It's that share of their market where their customers are paying that extremely high interest rate, that's the customer that's probably in the crosshairs of the worst of this pandemic in terms of job losses. That makes some of these brands of their portfolio vulnerable. And certainly Mitsubishi, Dodge, and Nissan lead the pack of all the different brands of being exposed to that vulnerability. And just doing the same analysis for the different brands, we can see that, subcompact car, compact car, full-size car, these customers of these products are paying the highest interest rates in the marketplace. Again, I don't think it's any coincidence that these are also the segments that have some of the largest year-over-year declines. And then at the other end of the spectrum, we can see a lot of luxury segments. Clearly, they're pulling the most best credit customers, so their customers are able to get the best FICO scores. It's important to keep in mind that when the industry advertises, as you're well aware, they're only advertising the 800 FICO score offer, the very best monthly payment out there. But as I was showing you in the previous slides, a large portion of the customer base is not even going to qualify for that. So the exposure out there to the affordability of this vehicles is really quite varied, but I think it does suggest that there are a lot of vulnerabilities. And we can see that for subcompact car, up to 40% of their customers are paying more than a 10% interest rate. Again, that suggests that segment is getting hit very, very hard because their customers are getting hit hard. And it could also be that these are the customers that are moving into the used market because these less than $25,000 price points or $30,000 price points in the new vehicle market, there's really just not a lot of product to choose from, at least not like in the old days. And folks may have many more choices in the used market to buy the vehicle that they're most interested in. So the other thing I just wanted to update you on is the inventory situation. I'm showing here on the left available supply of new vehicles, and you can see that over the summer months, particularly in August and September, year-over-year supply was very, very tight. We were hearing a number of anecdotal stories around the country of dealers saying, I don't got anything to sell. I might as well just close down this weekend. But the factories did get going. Sales started to wane a little bit, allowing the supply to catch up. So we are seeing that supply is improving. What we like to measure is days of supply. That's where it looks at how much available inventory do you have, what has been the sales pace over the last month. Based on the sales pace, your inventory will last this many days. And you can see the days of supply has been really volatile this year. During the depths of the crisis, when sales were essentially just frozen, days of supply really spiked close to 180 days. A lot of concern generated in the market. But once we got back to opening doors, sales started to happen again, and that day supply fell dramatically until it fell really far below more comfortable levels. Generally, the industry likes to keep things a little bit looser out there, but things got pretty tight over the summer. But as I said, it is starting to improve, but it's still below last year's levels. And so the question we've been wondering is this sort of the new normal? Does the industry want to keep inventories relatively tight, allowing them to hang back a little bit on incentives, or is this just a temporary situation? In other parts of the world, people come in and they order their vehicle and then they wait 3, 4, 5, 6 weeks for that vehicle to show up. In America, we want to go out on Saturday and come home with it. It's a very different purchasing model. It'll be interesting to see whether the industry will make some changes. My sense is what is happening is that the factories are now getting back to more normal levels of output right as demand is starting to wane even further. My concern is that the industry is going to keep that output coming because nobody likes to slow the factory line down. And we're going to end up with a situation like we almost always have, which is the industry keeps producing just as demand starts to wane, and we've got too much and we have to get aggressive on incentives again. We're not there yet, but I think that's something that could be on the horizon here in the first quarter if we see substantial changes in the buying rate here in the next few weeks. As I mentioned before about incentives, on a dollar basis, they are at a very high level. This is data that's going back to 2012, and you can see incentives have really been trending up, but it's a little bit misleading, right? Because we know vehicle prices have been rising as well. But I think what's really interesting about this, though, is I've highlighted in red, the red dot, that was April. That's when we really moved to those aggressive 0% financing offers. But since that time, incentives have actually been pulling back, and that's really in direct response to the tight inventory situation that we've been having, that the industry has not had to get as aggressive on incentives. And I think that's one of the big contributing factors that we're seeing some of these very, very strong profit numbers coming out of certainly out of the Detroit 3 in their last reporting quarter. So it seems to me the situation is likely to stay this way until we see that inventory situation change. So that's something to keep an eye on. The supply situation varies greatly across the different brands. You can see that LEXUS and Toyota have some of the tightest day supply situation. Of course, that's by design. Toyota generally keeps things fairly tight, but it may be also that we are hearing that there is some concern that they don't have enough product in the right places, that the right color, the right trim, body style, there are some hiccups along the way that maybe have a negative impact on sales. All of that's going to, we have to wait and see whether how the year finishes up, but it's certainly a headwind that is on top of everything else we're dealing with. Having limited inventory is the last thing that we need. What's interesting, I think, also is on the far right of this chart, you can see Lincoln, Buick, Genesis, some sort of luxury type brands, but are having very, very weak day supply. And it seems to me that it's that imported luxury, BMW, Mercedes, they're in a relatively tight inventory situation because sales have been fairly good. And so that's keeping things tight. I wouldn't be surprised to see some aggressive incentives by some of the Detroit luxury brands here as we move forward, because it appears that they're getting a little bit too much inventory. And the last thing about inventory I just want to mention is looking at the different price categories. Another interesting thing is that the price category of less than $20,000 and in the $20,000 to $30,000 range, the day's supply is substantially higher than the higher priced products in the marketplace. Those low priced products are just not selling nearly at the pace as the more expensive products. And all of that seems a little bit counterintuitive given the fact that we're in a very significant recession. But I think it really just comes to the fact that these buyers that are aimed at these price points, as I mentioned before, have been hit hard by this recession. And some of these folks have probably left and gone into the used market, or they've left the market entirely. But what's also interesting is that those price points of less than $30,000 represent about 35% of available supply that's out there in the market right now. So we have a whole bunch of the inventory of products that are really not what consumers are most interested in. And in addition to that, it also has a high composition of the old model year. On the right here, I'm showing the share of inventory that is a model year 2021, with the rest being model year 2020. And you can see that less than a $20,000 price point, only 25% of inventory is model year 2021. So there's a whole bunch of 2020s, and similar situation for the $20,000 to $30,000 range. Again, I would suggest that means that we're likely to see some heavy incentives on some of these lower priced products if we're going to try and clear them out. Certainly, folks are going to want to prefer to buy the latest model year over the previous model year. So I think some heavy discounting may be ahead of us for some of those segments. The other issue we're dealing with in the new market is average list price. We're almost at $40,000. It's really just taken off since the pandemic. It's a little bit of mix of the changing mix of vehicles contributing to this. Less cars that we've had through the year. More crossovers and trucks has certainly been boosting this. And we know that there is built-in inflation in these vehicles, that all of the technology, the new components, all of that is sort of leading to these higher prices. I think it's this affordability issue. The industry's been talking about it a long time. Well, we're really seeing prices start to rise, and I think that affordability is something the industry is going to be wrestling with. Can we get back to a 17 million market with vehicle prices, at $42,000, $43,000, in a couple of years? I think that's going to be a challenge. That's something the industry is going to have to really think about. Maybe that they're going to settle for lower volumes to have higher price points. So that may be something coming. Just looking at the year-over-year change, that's where you can really see sort of the built inflation. That if you put a trend line in there, clearly the year-over-year change on prices is they are rising, and they're rising much faster than people's incomes. And all of that suggests that these vehicles are getting more and more out of a basic consumer's price range. And now a quick update on the used market. We can see that available supply has also improved dramatically. The used market went through a much tighter supply situation a little bit earlier in the summer than new vehicles, but we're now starting to see it improving. A little bit more weakness in sales has allowed dealerships to catch up, as well as more trade-ins from the new market. Our expectation is that the market for the used market is going to finish at 36.3 million vehicles this year. That's down from the 40 million we did last year. But we're expecting 2021 to see a big jump in the used vehicle market, that we've, going up about another 3 million units from where we are this year. We think a lot of folks that wanted to upgrade vehicles or change vehicles this year likely pulled back from the marketplace just to let the dust settle. They're likely to re-enter here later this year, next year, as we continue the economic recovery. And you can see on the right the change in supply. Again, it's down from where we were, but it's certainly starting to improve. But it's still a little bit tighter. And all of that means is that this tight situation means that vehicle prices in the used market are also very high. They're now above $21,500 is the average price for the vehicles that we measure in the used market. We can't capture a private party activity in our data, but you can see that it's up about $3,000 from the depths of the pandemic. Almost a 20% increase. And as you can see on the right, the change in prices is actually accelerating. We're now looking at year-over-year changes on a weekly basis above 10% in the used vehicle market. The prices are really heading up quickly. The expectation, though, is that they're probably going to see these slow down a little bit, the price gains. The mix of vehicles is not going to be quite as favorable, as well as we are starting to see that demand is starting to wane a little bit. So we might not see the margins remain quite as high. But I think as long as the new vehicle market has the high price points it has, it's forcing people into the used market. So I think we're gonna have built-in demand in the used market because people need transportation. We're still scrapping, 13, 14 million vehicles a year that need to be replaced. People need transportation, and I think for more and more folks, the used vehicles market is their only option. The other interesting thing is when we look forward in the used vehicle market, we got to keep in mind that there's going to be less available inventory in the future. We had our record years in the new vehicle market back in 2015 and 2016 when we did 17.5 million. Well, we've been doing 500,000 sales less than that, at least we did last year. And boy, when we think about what we did this year, well, that means that come 2022, 2023, there's just not going to be near as many fleet vehicles available, off fleet, and certainly not off lease vehicles like we've had before. So the future for the gently used segment, that 0 to 4 model year, looks to be pretty tight for the used vehicle market here in coming years, and that would suggest that list price is going to be under quite a bit of inflationary pressure. So lastly, I just want to finish up. I've showed you this slide before, but I just want to talk a little bit about the election and what the Biden administration may mean for the vehicle market. There's certainly going to be a lot of policy changes coming. I won't go through all of these, but I think some of the biggest ones that are going to be the most interesting to automotive are likely to come around infrastructure. There's been a lot of talk about finally having a highway bill, a roads and bridges bill. President Trump talked about it for a long time, but we never got Congress to move on that. Biden is now talking about it. I think he will probably push this a little bit harder. So I wouldn't be surprised that we won't see some type of a big bill that would certainly be help spur interest in trucks, bigger SUVs, kind of construction type vehicles, and certainly that spending in general will only help add economic activity out there. But also along with infrastructure, the Biden administration and President Biden has talked about implementing 500,000 electric vehicle charging stations. Now that's a big investment. That's to be done by 2030. We currently have somewhere in the neighborhood of around 27,000 charging stations today. But if we're talking about having a nationwide infrastructure of a electric charging station network, and we really want to get people to buy these electric vehicles, we have to have that infrastructure, or else you're always going to have range anxiety. Folks aren't going to be able to get their vehicles charged, and there just aren't enough charging stations today to support folks buying more vehicles. So there could be a tremendous amount of support for electric vehicles in terms of the infrastructure, and we would not be surprised to see some sort of subsidies in addition to that added to electric vehicles. We already have the $7,500 one, but I wouldn't be surprised to see some additional monies, as well as some type of a cash for clunkers type program of some kind to try and get more interest and more buyers focused on these electric vehicles, because it does seem to be a big commitment of President Biden. The other one I think that could be important is around regulation, and the Consumer Financial Protection Bureau that was put in place under President Obama. And during that time, there was a lot of regulations around lending to subprime borrowers, restrictions around repossessions, things like that, that would really give more protection to borrowers. The Trump administration pulled back on that. It's likely to see that the Biden administration is going to continue to move forward again on that. So that would suggest that we may see that credit availability for some of the lower income folks in the new vehicle market, maybe a little, in the used vehicle market, maybe a little bit more constrained, might not be as liberal in lending to some of the lower FICO score customers. That's something that could be detrimental to sales as we look forward. So a lot of moving parts, but I would say in general, the next year is certainly going to have a lot of uncertainty, but I would suggest to you that we're in for a tough first half of the year. But as I said, the second half of the year looks to be much better. And in fact, there's a growing thought within economic circles that consumers have been sitting, the higher income consumers are sitting on a boatload of cash. The people have not been going out to eat, or at least not spending near the amounts of money that they normally do on eating out, certainly aren't spending near the amounts of money they do on travel. All of these things suggest that some of the upper income folks are sitting on a lot of income that could be spent. And then in the second half of next year, we may see a big unleashing of consumer spending on the U.S. economy that could really accelerate the economic recovery. And so that's one of the thought is going into 2021. So I hope everyone has a good year, and let's hope that 2021 is much better than 2020. I think it certainly will be.
Charlie, thanks for speaking with us today. We value your insights this past year and look forward to hearing from you in the months to come. And to those on the line, friends old and new, thank you for joining us all year long. We appreciate you all so much. We kick off 2021 with a webinar from Moss Adams that details the Biden administration's tax plan on January 7th at 2 p.m. Eastern. So be on the lookout for promotions on how to register. For more information about AIADA, visit aiada.org. Again, thanks for joining us. Happy holidays and best wishes going into the new year.